get us started. So hello and welcome all of you to this workshop, another EAA ISB Financial Reporting Standards workshop on the disclosure project this time. This is our last workshop before the summer break. We're really happy to have you here. We have now a very faithful and dedicated group of followers, let's say, who attend our workshops on a regular basis. That's very much appreciated. And we will basically observe a very similar format to the ones that we had in the past, with one exception. This time today we have 3 different academic contributors who will be commenting from different perspectives on the different parts and aspects of this exposure draft we're about to discuss today. This exposure draft, which is our topic today, the exposure draft 2021-3 disclosure requirements in IFRS standards, a pilot approach, and proposed amendments to IFRS 19 and IS 19 is really an outcome of the disclosure project, which tries to address the disclosure problem, which is described either as a disclosure overload issue or an issue related to a lack of sufficiently useful and specific disclosures. And we'll also hear from EFRAG and hear about EFRAG's draft comment letter on the disclosure exposure draft. And we'll also again answer questions from you, from the audience, and would like to obtain your feedback on these proposals and hear about this related academic evidence. And in order to provide this academic evidence, we have, again, like I said, invited 3 academic contributors, who I'm going to announce in a second. In terms of participants today, we have Ann Tarca for the ISB board. Ann needs no introduction. She has been a regular participant in these workshops. She's our ISB board member representative. We have Catherine Donkersley, the ISB technical staff and project lead for the disclosure project. And we have 2 representatives from EFRAG here today, Katrin Schöne, project director, and Osim Kebli, senior technical manager at EFRAG. Our academic commentators today for the pilot approach and the general disclosure aspects is Paul André, professor of financial analysis at HEC Lausanne, and he's also there the director of the Master of Science in Accounting Control and Finance. Welcome, Paul. Thanks for being with us today. For IFRS 13, the IFRS 13 disclosures, which also feature in the exposure draft, we have Andrei Filip. He's a professor of financial reporting at ESSEC Business School and the incoming editor, by the way, of Accounting in Europe, one of our association journals. And last but not least, I want to welcome Vicky Kiosse, Associate Professor of Accounting and the Director of Doctoral Students in Accounting at University of Exeter. And Vicky will focus on pension disclosures under IS 19 in the new exposure draft. Again, as most of you are familiar with, the format for this session today, first we'll hear an overview of the ISB's proposals, and then EFRAG's input into these proposals before our academic commentators will provide their insights into the academic evidence relevant to this project. We will follow each of the 2 sections we'll have by questions and feedback from you. Please post your questions and comments into the chat. If you would like to speak up, just post your question as is. If you would not like to speak up and just would like to share your insights in the chat, please preface them by chat only. And after we have exhausted now our discussion, we will then move to the next section. Again, 2 sections we have today. First of all, we'll start with part 1, the pilot approach, the general approach, the principles-based approach of this exposure draft. And then we'll move into the specific applications of this pilot approach for 2 specific standards, IFRS 13 on fair value measurements and IS 19 on pensions on employee benefits. Good. Then I think we're ready to start the first part, which will be presented by Ann Tarca and Catherine Donkersley. And I would like to ask Anna Simpson, who's also with us today, to share her screen and her slides and handing over to you, Anne and Catherine. Thanks for being here with us today, and the floor is yours.
Thanks very much, Thorsten, and we greatly appreciate being here. So thank you to Thorsten and his EAA colleagues. It's a great pleasure to have this presentation with you today. We hope you find it very informative. We'd like to talk about our proposals in this exposure draft. We're also interested in research that's relevant. Anna Simpson has shared her email in the chat box. So please, if you have relevant research that you'd like to bring to our attention, please use Anna's email. So it's my pleasure to introduce this presentation today before I hand over to Catherine. So briefly, the disclosure problem is the subject of this ED. Thorsten's referred to this as the disclosure overload problem, or sometimes we hear people talking about boilerplate or cut the clutter. It's not a new problem. We've been looking at this. We, the standard setters, people in practice, academics, have been looking at this problem for many years now. So this particular project comes out of a long line of thinking and research and evidence. So the starting point is identifying a problem, and standard setting should always look at whether there is a problem, the nature of that problem, what is the evidence about the problem. And so that's what we've been doing here, examining the problem. And we're summarizing it for you here on slide 2 as not enough relevant information and too much irrelevant information. And what does that mean if we have that? We have ineffective communication in the information that's provided. Next slide, please. So we've gathered a lot of feedback along the way, and we are very aware, no, slide 3. We're very aware that some people find compliance easier with a checklist, but many of you in the audience have done disclosure-related research, and academic research shows a lack of compliance even when there is a checklist. So some people tell us it's easier if there's a checklist, and that's the easiest way to get compliance. But something we also observe is a lack of material information, and we're not sure that the use of checklists is effective in getting useful information. We're not sure about the application of materiality and how that's being applied in practice. Is it being applied in such a way that we're getting the useful information, that it's visible to people, that it is communicated to them? In our research, we've also discovered feedback from companies that suggests they don't always understand why information is useful to investors. And the feedback was also clear about activity from standard setting from the board. So this project is based on feedback we've received that suggests that the board can help by taking an active role in this issue. Slide 4, please. So yes, the board is taking an active role and taking an initiative in this project we want to talk to you about today, but we're not the only ones. We can't fix the disclosure problem. This slide with the dominoes just illustrates for you visually the idea that companies, auditors, regulators, and others are all involved in this disclosure project and responding to disclosure issues. As part of this process, we've also consulted with investors. It's not that we aren't thinking about investors. We are thinking very much about them and how information can be communicated. So to address a disclosure problem means that all the parties involved need to play their part. And the board's view is that by taking an initiative, we can kickstart a process to improve the process by which people provide information and indeed improve the disclosures that are provided. Next slide, please. So this slide sets out for us the approach that the board has taken. And the first step was to develop guidance. So board and staff together developed a set of guidance to developing and drafting disclosure requirements. Now, it's not that disclosure requirements in prior standards are not carefully thought through and discussed and deliberated on. Of course they are. And we have had major standards introduced over the last several years, and a lot of work has gone into the disclosure requirements on those major new standards. But what we're proposing here is a new approach to how we develop and draft the disclosure requirements. The next thing that the board did was to test the proposed guidance, and we selected 2 appropriate standards through a very careful process. And those 2 standards are IFRS 13, fair value measurement, and IAS 19, pensions, employee benefits. So we are going to explain some detail about those today. And those were the standards used to test the guidance. The third step on the slide is preparing an exposure draft of the proposed guidance, and that is the document that's available now, and that's the document on which we're seeking your feedback and other people's feedback. So we have specific proposed amendments into IFRS 13 and IAS 19 that reflect the application of the guidance, and we're seeking people's feedback. This is a major change in how the board approaches developing and drafting disclosure requirements. We really need feedback. We need feedback from a range of stakeholders on all the aspects of this before we take it on board. We need the feedback to determine whether this is going to achieve the goal that we're trying to address, which is the disclosure problem. So I'm going to hand over now to Catherine, and she's going to explain in more detail. Thank you, Catherine.
Thanks very much, Anne. So over the next few slides, I'm going to summarise some key aspects of the guidance for the board that Anne just described. What I'll do is share with you the feedback we heard and the main ways in which the proposals respond. I will then look briefly at some likely effects of these proposals, highlighting in particular a few of what I might call the hot topics, the areas that have caused the most debate and discussion since we published the exposure draft. So on slide 7, starting with an overview of the proposed approach, I won't cover every aspect, but I will summarise these 3 areas, taking each one in turn. In summary, though, what the proposals are intended to do is respond to that feedback that Anne described, and coming back to her point about this being something of a catalyst for change and other stakeholders needing to be involved too, what the proposals are intended to do is give stakeholders the tools that they have consistently told us they need to be able to play their part in improving the effectiveness of disclosure. So taking the first of 3 key points I'll raise on slide 8. As I mentioned, we've consistently heard that companies do not always understand why information is useful, and therefore they can find it difficult to make effective judgments about whether that information is material in their own circumstances. So this first proposal would address that by making sure the board has a detailed understanding of stakeholder needs very early in the standard setting process, so it can then reflect those needs in the standards. One really important example of this is spending time with individual users of financial statements to understand their information needs in depth. Not just what information is useful, but why is it useful? What would they do with it in practical terms? How detailed does it need to be? And what is most important versus more of a nice to have? The second point on slide 9 is about how the board would use all of that feedback and reflect it in the standards. So the board would take that information from investors and develop disclosure objectives that directly reflect their most important and common needs. Those objectives would also be followed by explanations of what the information provided is intended to help investors to do. And the purpose of those objectives and the additional explanations is really to put companies in a position to understand why disclosure is needed and help them make those all important judgments. The second important benefit of this approach, disclosure objectives, is that the only way to apply with them is by applying judgment and disclosing that information which most effectively meets the described user needs. So Anne mentioned the fact that we are told today that many see applying the disclosure requirements in the standards as a checklist, as a safest thing to do. Under this approach, using disclosure objectives, that checklist approach wouldn't really achieve compliance because you do need to consider, has the objective been met? That said, achieving compliance with objectives and the fact that it requires judgment means that it can be challenging. Recognising that, the board has put many things into the proposals that are intended to serve as tools to help companies apply effective judgment and help others such as auditors and regulators review them. That's a concept that I'll come back to in a couple of slides' time. So the third key point I'll mention on slide 10 is really taking that idea of applying judgment to determine what is material and extending it further through the board's use of language. The board is proposing to typically focus the compliance requirement, so the words an entity shall disclose, on those objectives. The items of information that would follow those objectives would in most cases not be described in the standards using prescriptive language. Instead, the board would use the words, whilst not mandatory, the following information may enable an entity to meet the specific disclosure objective. And what that means in practical terms is that this perceived checklist goes away. Companies would no longer be required to disclose a list of particular items, but would be required to satisfy objectives in order to comply with the standards. Disclosing boilerplate information would not be helpful in that type of compliance because it would not help a company to meet the objectives. And instead, the way to comply would be to disclose the information that is most relevant and most useful. Moving on then to talk about some likely effects of the proposals. As mentioned, what I'm going to do here is be very honest and share with you some of the most frequent questions and hot discussion topics we've heard about. So first is a suggestion that the proposals require companies to apply judgment about disclosures for the first time and question whether they and other stakeholders would be able to apply the level of judgment needed. The first thing I'd say, and it is really important, is that, of course, the standards already require judgment. Individual standards do contain these prescriptive disclosure requirements, but of course, IAS 1 requires materiality to be applied across the board. What the proposals do is make that need for judgment explicitly clear in the disclosure requirements of individual standards. But the judgment is not a new concept. Both today and applying the proposals, the standards require a company to apply judgment, and auditors and regulators are then required to review and enforce that judgment. It is true, however, that judgment is not always being applied entirely effectively today. So a question we hear is, well, if stakeholders cannot apply judgment today, how is the board comfortable in making that need for judgment even more prominent? And moving on to the next slide, my answer to that is that what these proposals really do is two things. Firstly, they reinforce the need for judgment that is already required by IAS 1 by putting it right there at individual disclosure requirement level. But also, very importantly, they give companies loads of help in making those judgments. So the things you can see on the slide, along with the detail and specificity within the disclosure objectives, they would also be supplemented by explanations of what users would do with the information, items of information that may help to satisfy the objectives, and where needed, application guidance and illustrative examples. So companies, auditors and others would have loads more tools than they have today in applying and enforcing the necessary judgment. So if, for example, I was an auditor, today it might be challenging to ask a company to add additional relevant information on the basis of that overarching IAS 1 requirement. Under these proposals, an auditor would be able to point in the standards to the precise user need that a company is required to enable to be satisfied in its financial statements and have a much more robust basis to have those discussions. The final thing I'm going to mention on slide 14 is comparability. When it comes to disclosures, there is a long acknowledged tension between entity-specific relevant information and comparable information. And a question that is understandably asked is whether, given the increased emphasis on judgment and relevance brought about by these proposals, will they negatively affect comparability? A couple of things to say. The first is that uniform information and comparable information are not the same thing. If you have two companies for which the same information is genuinely material, the companies are very similar, uniform information is a fantastic thing that is beneficial to investors. On the other hand, if what's really material to those two companies is different, then it could almost be a little bit misleading to force them to give uniform sets of data, and recognizing that both companies disclose what is material, and therefore a user can compare material information with material information would achieve what we are thinking of as material comparability. The second thing to say is to reiterate all of those tools in the standards to help a company apply the judgment necessary. The board's view is that the proposals are of a good enough quality to enable companies to identify and reflect all of the information that is material in satisfying objectives in their financial statements. And therefore, if the same information is material to more than one company, we would expect them both to disclose it, thereby achieving comparability when it matters. That's when the information is material to multiple companies and useful to investors. So that was a whistle-stop tour of the proposals and some of the big issues. I will stop there and hand over to you, Thorsten, I think.
Yes, thank you very much, Catherine. Very impressive, very focused introduction to this very ambitious approach. I would like to ask now Katrin to share EFRAG's views on these proposals, including points that you will raise in your upcoming comment letter. Katrin, please.
Thank you, Thorsten. And thanks for having us here today to share our views. On the first slide from our presentation, you can see the timeline. So the timeline, we are currently working on the field test. So we were searching for field test participants and that they are doing mock-up disclosures to test the approach. Users and auditors are highly interested in the field test results to give their own feedback afterwards. And so there would be, from our point of view, a second step necessary after the field test, that those field test results are discussed by the users and the auditors more extensively. So the next slide, you can see some of our general comments. EFRAG welcomes the development of the rigorous methodology to define objective-based disclosures and requirements and support the objective of the project. EFRAG also understands that the ISB focus on the provision of more relevant disclosures and not on changing the volume of disclosures. EFRAG continues to hold the view expressed in its 2017 comment letter in response to the ISB discussion paper that developing and testing such an approach has merits and should be encouraged, as we support the reduction of detailed disclosure checklists. EFRAG agrees in particular with the proposal to work more closely with the users of financial statements and other stakeholders early in the standard setting process. And it is important to understand what information needs they have and to articulate better how such information is used by them. EFRAG observed that the exposure draft does not explain the relationship between individual disclosure objectives in IFRS standards and the concept of materiality. Such an understanding of the relationship is essential from our point of view, and so EFRAG recommends that the ISB further consider and explain this relationship. The specific objectives in the proposal are developed based on decision usefulness of the information for users. EFRAG invite the ISB to explain whether and how the objectives serve the stewardship objective of financial reporting. Digital reporting becomes more and more a relevant factor. So EFRAG encourages the ISB to further consider the interaction between the proposals in the exposure draft and the increased use of digital reporting, as comparability of the information is prerequisite of an effective use of technology-based reporting. On the next slide, we come up with one of the key questions raised in the draft comment letter, which is, are minimum disclosure requirements necessary to meet the disclosure objectives? Or is mandating overall and specific objectives for such IFRS standards enough? The proposed approach increases the emphasis on the requirement to meet a disclosure objective rather than specifying particular items that are required to be disclosed to meet an objective. Actually, in most cases, the ISB expects to list only non-mandatory items that may enable a preparer to meet the disclosure objective to be provided. EFRAG note that the proposed approach introduced a radical change from the existing guidance by making minimum requirements an exception. The users of financial statements highlighted the importance of both entity-specific information and comparable information. EFRAG considered that by focusing the objectives on the provision of entity-specific information and a higher level of judgment, the proposals will likely create implementation challenges and tensions with comparability. Although EFRAG support the reduction of detailed checklists of disclosures, we do not support the classification of certain disclosure requirements as non-mandatory or making minimum requirements an exception as proposed. The success of the proposed approach depends on striking out the right balance from our point of view of this approach. We are concerned that absent a list of minimum disclosure requirements, the proposed approach would expose preparers to second guessing. It would also make review of such disclosures and enforcement of the requirements more difficult for auditors and regulators, and may ultimately not lead to the intended changes and improvements to information relevance. On the next slide, we see some other challenges on the use of prescriptive language. EFRAG is concerned that if the objectives are not specific enough to be operational and enforceable, the expression while non-mandatory might be misunderstood and result in material information being omitted. The non-mandatory is explained in the basis for conclusion. We would appreciate, or we propose to explain this in the body of the standard and not only in the basis for conclusion, that there is no misunderstanding possible. Related to that might be enforceability and auditability issues that put more emphasis and therefore maybe some more burden on the level of judgment for preparers. So another aspect is that EFRAG observed that different type of users exist that may have different information needs. So lenders might have different information needs compared to equity investors. Assessing the common information needs of a variety of users and the dynamic nature of their information needs over time is challenging. It's challenging as well for the auditors and for the enforcers and not only for the preparers. So on the next slide, we come up to one of the topics that we would like to address. It's that it is really necessary to test the approach and to understand how the reporting would change under this approach. So field testing is here really essential, and we tried to find field test participants. It was difficult. Up to now, we have a few, but not so many as we think would be really beneficial. EFRAG note that the final impact of the proposals depends to some extent on the willingness of the preparers to undertake a change to their approach to the use of judgment and to their appetite to reduce the number of current disclosures. So some of them might stay with the approach that they have been applying over the last years. Assessing the costs where the benefits of the new approach is really paramount. So the benefits and costs are part of are addressed during the field testing, and we try to get a certain understanding about that. EFRAG also note that in assessing the benefits, it is necessary here to consider also the potential loss of information that is currently provided. Understanding the potential for loss of information would also give us some understanding about the discussed minimum disclosure requirements and whether they are needed or not needed. So assessing the benefits for preparers and for users from the proposed approach may not be an easy task. The proposals will only achieve their full benefits if not only preparers of financial statements, but also auditors and regulators use appropriate judgment when applying these requirements. So it's as well a new task for the auditors. The effects of the proposals may vary based on the diverse nature of entities. So small or large entities might have different understanding of the proposals and different a different approach. What we try to address in the field testing as well, to have some smaller participants, because for those companies, our understanding is that they really appreciate the checklist approach. But on the other hand, we understand that it is necessary for them as well to focus on the relevant information. So comment period is the last topic that we are having here on the slides. So as I said already before, the field testing is really essential for this project to understand the benefits and the changes that will come up. And we would appreciate a certain substantially longer period for consultation because we were not able to find enough field test participants up to now. And from our point of view, it's really necessary to test this in detail and to do this second step that I was referring to at the beginning. Thank you.
Yes, thank you very much, Katrin. A lot of points for the ISB to consider, and Paul, you will be adding more, I expect. Please let us have your academic views on these principles. Thanks, Paul.
All right. Thank you, Thorsten. Thank you to the EAA and the FRSC to have invited me to give a bit of insights from research on this topic. It's not a new topic, and it's a very broad topic. So I think I'll be probably coming back with a lot of things that are already known, but I'll try to nevertheless focus them based on this exposure draft. So on the next slide, I figured I would start. Actually, I was going to start with why do we need mandated disclosures from the starting point, but I figured we'd be here till tomorrow if I did that. But I still think it's interesting to understand what are some of the constraints to voluntary disclosures, which to me are also in some sense some constraints to quality mandatory disclosures. And the Graham et al. Paper that interviewed 400 sort of CFOs, and I think is one of the most extensive sort of, I think, interview survey of preparers, if you want, pointed out a number of interesting sort of issues that will challenge, in some sense, if you want, I think, the implementation. It was surprising to see that one of the first things is a problem with commitment. Managers don't like to commit to have to sort of give information continuously over time. Yet we do know that users want regular, timely, comparable, consistent information, if you want, over time. And that's one of the purposes of the mandatory disclosure. The second is the sort of another sort of usual suspect, which is always the issue of proprietary cost. And it's always a challenge to balance, in some sense, the notion that you don't want mandatory disclosures to sort of have impacts on real decision, impact, if you want, investment decisions, but at the same time, a certain amount of that information is important for users, both if you want to look at the stewardship or the value creation sort of activity. The third one is litigation. And again, we do know this. So litigation risks are an issue, and maybe more so in some jurisdictions than others. And this is a US study, so probably very important in this context. But again, the litigation opens up this issue. For checklists do sometimes sort of allow firms to be able to say that they've met, in some sense, their legal obligations. And sometimes if you have too much of open-ended type of, if you want, guidelines, they end up putting a lot more stuff just to try to protect themselves. And it sort of defeats the purpose of trying to avoid, if you want, or trying to this information overload. The three other points point, if you want, to typical other sort of explanations, which are basically agency cost, and it may be at the bottom of the list. I think managers probably are more worried about that than they were ready to say, if you want, and if you want, political risks, or the risk that regulators will scrutinize them more. So all of that to say that there's some things that block, if you want, firms from fully disclosing, if you want, the information, and we need to understand that. They do give a lot of voluntary information, and I think this paper also points out to the fact that firms do generally want to, at least a certain number of firms, to establish, if you want, a reputation for being transparent in the disclosures, for reducing information risk, and sometimes even supplementing the information that is in the prescribed, if you want, standards of the standard setters. But one of the challenges there too is that some point, if you take away all the ability to signal sometimes one's quality, we lose out as users with respect to the information. Next slide, please. So I'm going to look at a couple of, in fact, survey papers that try to look a little bit at compliance. And again, I think these are probably already known in the community, but I think just trying to bring out a certain number of items are maybe important. So this Salavutas et al. Paper in 2020 looked at 70, if you want, post-2005 compliance studies. as they point out, a bunch of them are very single country or small markets, whereas another bunch of them are large EU firms. So it's not always easy to generalize from all of these studies, but they do point out to some limitations that we know from these studies. The concept or the challenge of measuring compliance. And we have a lot of metrics. There's a lot of issues with these metrics because some people think that they measure more quantity, or in some sense, this notion of box ticking rather than maybe capturing quality. And that is one issue with the, trying to get some sort of something from all of these studies. Many of them don't consider materiality, so we do know that they're likely overstating, in fact, the lack of compliance out there. Now, this study points to a whole series of standards that seem to be poor compliance sort of standards. The surprising thing is that there's quite a mix of standards there, some that are sometimes considered to be already a bit more principle-based, and others that are more, if you want, checklists, sort of maybe the older ones. So it's surprising to see that both types end up sometimes giving out the impression that there is poor compliance. We know the usual suspects, that there's a lot of cross-country differences, and that's a particular challenge for the IASB compared maybe to the FASB, is that there's varying levels of enforcement, of audit quality out there, and that's a challenge. And then there is the firm size issue, and I think that's been pointed out by EFRAG, that that mandatory disclosures impose a fixed cost to firms, and it's obviously ends up being sort of a larger burden to smaller firms. So it's always a bit of a challenge trying to take into consideration likely sort of different environment context with respect to larger and smaller firms. And we do know, we in Switzerland know this sort of natural experiments of firms that have opted out of IFRS to go back to local GAAP, which have often expressed that one of the issues is the overburden of disclosures and information that they need to supply under the current sort of rules. Now, few examine market consequences, and I think one of the challenges with all this literature is very weak identification strategies. So it's very questionable to establish causal links between, in some sense, the quality, the compliance, and some market-wide consequences. Next slide, please. The second paper that sort of surveys, if you want, a little bit the literature itself, and this is the Hellman et al. Paper, an Accounting in Europe paper published in 2018, following the IASB forum, I think in 2017, so 4 or 5 years ago, does look at 81 different papers from 98 to 2017. They also point out that, in some sense, at least the metrics that we have point to low compliance. Both in a way, they start by sort of pointing to the weak or legal and institutional sort of types environments, but surprisingly, we find that even in developed countries and in more sophisticated, if you want, legal and institutional environments, that we also find low compliance. They do argue some of the same issues, that there's problems with the indices that we use. So we have a challenge to measure, in some sense, the whole notion of compliance and what is the benchmark. I think one of the, I've had this discussion before. We standard setters have said that they don't necessarily expect 100% compliance, given the types of indices that we're using. So, but what is the benchmark? What is, in some sense, the best in class or gold standard? And that's something that we're missing to try to figure out, if you want, the quality, the overall quality, if you want, of compliance. But again, here they do point at larger firms, listed firms, firms with better corporate governance have a tendency to be more compliant. And then they make a point that there are also cultural sort of differences influences in the way people interpret rules and how they apply them. I always like to say that I have fun in Switzerland because being Canadian more from a British type sort of, we often say that we look at rules and we say, if something's not forbidden, it's permitted. And then my Swiss friends say, no, if it's not permitted, it is forbidden. So even in a similar, we have different interpretations and way of thinking about how to sort of look at rules. Next slide, please. I'll go very quickly because this is just to point out in this study, you can see that there's a lot of variability with respect to at least the compliance that's been measured by these are 17 studies in emerging markets, but with an average around 65% compliance. But with large, like I say, sometimes the differences between the upper and lower bounds. So that there is a fair number of companies which are audited, if you want, and in environments where you find it surprising that level of compliance, if you want, for publicly listed companies. Next slide, please. But it's not, and I think this slide says it's not just developing countries, and even in developed countries, these studies have also sort of documented a fair amount of variance with respect to disclosure compliance, and they are barely around 70%, if you want, compliance in these types of studies. Next slide, please. Now, this paper has the advantage of also looking at some work that's been done on specific standards. So it's not the ones that are being tested, if you want, in this exposure draft, but there's a lot of work on business combinations, goodwill, impairment tests. One of the at least advantage of some of these studies is that many of them have tried to impose at least a materiality type sort of metric to be able to measure compliance properly, given the size of either the goodwill level, the impairment level, if you want. So what's surprising is that there still seems to be documented a fairly low level of compliance. And what's also pointed out is that the IFRS 3 sort of disclosure sort of rules are closer maybe to where this exposure draft is going, compared maybe to IS 36, which is more sort of checklist type, and yet the level of compliance is not necessarily that different between the two standards. Financial instruments and risk reporting has been looked at a lot, but there, given it's very principle-based, it's even much more difficult to measure compliance. But a third area of research, which is maybe interesting to focus on, is segment reporting. And there we have a more flexible open management type approach. And I think that the literature has shown that flexibility, and if there's low enforceability, well, it can lead again to a fairly significant level of variation in disclosure quality and quantity. And at least there, people have tried to distinguish between these two constructs, and we know that firms can actually play a little bit on both dimensions. They can look like they're compliant by being very box tickers, but at the same time have lower quality, given if that when we try to figure out the information we're getting from the different segments, and many feel that that we've sacrificed a bit in this standard, the cross-firm comparability, which has been pointed out with before, that we may have consistency over time, but we've lost a lot with respect to comparability across firms. Next slide, please. So in this paper asks the types of questions that are being asked and were presented at the beginning by Ann. Is there too much irrelevant information? Users do always, in some sense, prefer more sometimes to less. And there is a lot of research out there that does indicate that more information has some positive market consequences, and that at least sophisticated users can generally decode the information. And I would say that maybe, that also links to the issue as we move towards a more sort of an environment where it's machine reading and machine analysis, that machines can deal with a lot of information, maybe more than if you want individuals can. So we may need to be careful about that, imposing that constraint of user challenges with respect to digesting in some sense the information. And is there enough information? Yes, it's pointed out that it should be more decision sort of context specific, and I'll come back and end a little bit with that challenge, and that the enforcement context is incredibly important. Next slide, please. So another Accounting in Europe paper by Barker et al., which was discussing the EFRAG and CFRC, I think, a sort of paper a few years back, and also the ICAS in New Zealand sort of exercise, does try to sort of bring out the notion that principle-based can lead to many outcomes, and that returns to this issue of the problem of comparability. That principle-based disclosures can be much more difficult to enforce and to audit, and that high incentive situation, or if you want, where costs, maybe agency costs or proprietary costs are higher, seems to lead to poorer disclosure quality. So next slide, please. Maybe on this user and their needs, again, this Casino et al. Paper published in 2014, again in Accounting in Europe, does, I think, bring out the challenges that have been mentioned also by EFRAG in the previous sort of slides, that there are quite a variety of key capital providers, at least if we just look at Europe, but I think that's also the fact for most of the rest of the world, except maybe sort of more investor-driven sort of economies like the US or the UK. So, and even inside there, you've got different types of equity investors, from professional investors that need a lot of information, outside private retail investors, which are more worried about the overload issue, inside equity investors, which are also often more interested in internal sort of decision issues. And then, as been pointed out, you also have debt providers and you have trade creditors. And as they point out, they may have very different sort of information needs. They use information in very different ways. And as has been pointed out, sometimes they compete. We've known for a long time that the challenge of supplying information that is both useful for stewardship purposes and valuation or value creation can be challenging. And that will be a challenge, I think, for the standard setters. So it will be difficult to identify the typical target. And at some point, at least this paper ends up saying, well, maybe we need to focus on the competitive advantage of financial reporting, given that there's a lot of other ways for firms to supply information, if you want, to users. And there the focus maybe on more verifiable, objective, regular, but also more standardized, if you want to, settings, which again, given, if you want, digital, if you want, or electronic filings, electronic retrieval and analysis will become more and more important. So to end with the next and last slide, there are still a lot of research opportunities for all of us out there, and the challenges, I think the Loers and Wysocki paper really sort of pins down some of the incredible challenges we have, but to try to link regulatory change with disclosure outcomes and then the economic consequences of all that. And because of a number of issues, and both identification, measuring cost benefit sort of trade-offs, and the challenge of constructing financial reporting quality metrics. But as they point out, I think pilot studies and field experiments are probably one thing that could help. And I think the EFRAG is really working on that front, I think. And we do know that new techniques of language, natural language processing may help us better understand other dimensions of quality and not just quantity. So there are my 2 cents on some research insights that might guide the exposure draft.
Thank you very much, Paul. Also very rich, and as you said in the beginning, this topic is not entirely new. It's a version of principles versus standards or rules in a sense. I'm looking at the chat here, and I do have a couple of comments in here. The first one comes from Pauline Wheatman, although it's prefaced by chat only. I do want to use it in one of my own points. So one of the core points also made by Katrin and by Paul to some extent is with this principles-based, less prescriptive approach, how do we safeguard against overly restrictive materiality judgments, and how do we avoid putting a lot of weight on the shoulders of auditors and enforcers, and to kind of use Pauline's point a little bit. How will the ISB deal with anticipated demand, including from auditors, for more detailed guidance to avoid second guessing, which is apparently, as Pauline mentions, the experience that the SEC has made? Maybe we can start with that.
I'm happy to jump in, Thorsten, if that's appropriate.
Sure.
Yes. So in terms of the first part of what you asked, the risk of almost too much burden on auditors and such, I would say that burden actually already exists because the requirement to apply materiality already exists. That is a requirement in the standards, and what the proposals do is give a lot more support in dealing with that. Now, I would say that it would be naive of me to suggest that is an easy thing. It absolutely isn't. But Anne described brilliantly at the start of the session the problem that exists, and the fact of the matter is that the status quo in terms of this people relying on prescriptive requirements is not leading to disclosures that are meeting the needs of users for all the reasons that Anne described, and therefore acknowledging how difficult judgment is, if we are to get to a place together where the disclosure problem is effectively addressed, we need to find a way to enable collectively all of us involved in financial reporting to facilitate that judgment so that it can be done by all of those that need to do it. And that's ultimately what the board is aiming for in these proposals. And what we're looking for from stakeholders is constructive feedback about, okay, if this isn't enough to allow you to apply judgment, what more do you need? Because I think looking at the problem and the years and years over which we've heard about it, as Paul has reiterated, it's not a new problem. It is about working together to put in place the things that will genuinely enable judgment, because in the absence of that, the problem won't be solved. So I agree with the questions that have been asked. They're great questions, but I think it's about finding a solution to that challenge of how to perform judgment, rather than kind of saying the onus is too great, it can't be done, if that makes sense.
Mm-hmm. Thanks a lot, Catherine. Anne, would you like to add?
Yeah, thanks, Thorsten.
Please.
I take Pauline's point about the SEC guidance and the investigations of MD&A. But what we're hoping in these proposals is that we've given enough specific guidance. We've given very detailed, these disclosure objectives have had a lot of thought behind them, the overarching ones, the specific ones. And remember, there, as you'll hear shortly in the presentation, there's a lot of detail in terms of the examples of things that entities may disclose. While not mandatory, they may disclose the following. So there's been a lot of thinking about items of information that can be useful. So we're hoping there's more detail in there than, say, there is in something like MD&A guidance, which of necessity is framed in a way to be suitable for multiple entities across all their operations. These disclosure objectives, the overarching and the specific, are framed in terms of specific accounting standards. So we've got the advantage that you don't have in a more general MD&A type framework, because we've got specific standards, and these disclosures objectives go with some specific standards. So I think we're on a narrower path, but we're interested in feedback. So please, if people have got feedback on this. This is what we need to hear. And if people have got research evidence that is taken from another area, such as management commentary, or indeed any of the accounting standards, and then can be applied across. And there are some learnings from that evidence for this project. We're very keen to hear about it. So thank you.
Mm-hmm. Thank you, Anne. I want to hand over to Zoltan Novotnivakas from Vienna, who has a question about how this all links to the FASB's similar initiatives. Zoltan, please.
Yeah, so thank you very much for the presentation so far. And I would like to take also the opportunity to thank Thorsten and the EA for providing this flat platform. My question is that the FASB has a similar project. They started a couple of years earlier, and they also issued disclosure guidance or principles of disclosure that were ultimately also implemented in their conceptual framework. And they also tested in a similar way, like now the ISB on the fair value measurement standards and pension accounting. So I imagine that they have, valuable experience from this whole project that might be also beneficial for the ISB's work. And my questions related to this: did the ISB exchange experiences? And also, if yes, so what would you see as the major differences in the FASB's and the ISB's approach in this regard? And since the FASB decided to implement these principles, for the ISB's the disclosure guidance into the conceptual framework, is this something that the ISB plans? Because it reads to me like a conceptual framework when I read the guidance. And if not, why not?
I'm happy to come in again. So great questions, thank you. Your first question, did the two boards liaise? The short answer to that is yes. So every year the IASB and the FASB have a joint meeting where they sit around one table or one virtual table at the moment together, and for a period over 2 years where these proposals were being developed, this topic was absolutely on the agenda. The board sharing their experiences, sharing what they were learning, what they were proposing, and working together to take the collective learnings. So yes is the answer to that one. In terms of the key differences, I would say they are very reflective of US GAAP and IFRS being quite different beasts. And in fact, what the FASB's disclosure framework does is go through different types of asset, liability, and describe different things the board should consider in coming up with disclosure requirements for those items. That is very different to what the board is doing, which is all about the board's process and how it comes up with the right requirements in the first place. So investor liaison and such, and then how it puts those requirements in the standards in terms of objectives, etc. So to be honest, I mean, I could talk for an hour about it, but it's kind of like comparing apples and oranges. That they are very different beasts. In terms of the actual standards, as you mentioned on the chat, the two standards we've picked were looked at by the FASB. And again, I could talk for an hour on that, but I'll be good and avoid it. The two pension standards weren't very similar to start with. So the better comparison is fair value measurement, where the disclosure requirements of the FASB standard and the IASB standard were, of course, very similar. And I will be talking about IFRS 13 a little bit later, but at a very, very high level, our findings on IFRS 13 were less about content of information and more about application of materiality. So there's a lot about the way in which the proposals are put into the standards to encourage those behavioural changes, and in terms of content, there haven't been sort of significant differences introduced, but again, because we do things in such different ways, that you have to be careful comparing. Your final question, are we going to put the guidance for the board into the conceptual framework? I'm afraid I have to do the IFRS Foundation classic and say it depends, and the reason it depends is because stakeholder feedback is so incredibly important, and the board is going to make an informed decision about next steps when it's heard from all of its stakeholders. So with apologies, I'm going to dodge that last question.
Thank you, Catherine.
Thank you very much.
Good. I think this nicely summarizes our first section, and let me now hand over again to Catherine and Anne to present the second part, application of the principles to the two test standards, IFRS 13 and IS 19.
Thank you very much, Thorsten, and I will jump in first on this part of the presentation. So what I'm going to do is summarise some of what happened when the board applied its proposed approach to those two test standards. So moving on to the first slide, the first thing to say is that the board applied all aspects of what we've just described to these two standards, including that all-important outreach with stakeholders. And as you can see from the slide, that included talking to all different types of users. So coming to earlier comments from some of the presenters about different users having different needs, we did cover them all. And in line with what is in our conceptual framework, it was a case of identifying those common needs that financial reporting should really be addressing. You can see from the slide, we also talked to other stakeholders, for example, talking to preparers about different ways the user needs could be met and the relative costs and practicalities of those. So using all of that input, the board went on to develop proposals for the two test standards. So on the next slide, we've got IFRS 13. And I actually mentioned this in response to the previous question, but in short, what we heard here is that it is all about materiality. Users tell us they often get pages of information about immaterial fair value measurements and little information about fair value measurements they regard as significant, whilst at the same time, companies tell us that those pages of information are onerous to prepare, users rarely ask any questions about them, and therefore preparers are feeling like the cost-benefit test is not necessarily working here. So to sum up, it is about materiality here rather than saying the technical content of existing IFRS 13 disclosures is wrong. It's more that good information really needs to be provided about the most useful population of items. So really an effective response from the board here would be to come up with a set of disclosure requirements that helps companies focus their information on those fair value measurements that users are interested in. And the board's proposals are intended to do that in a few ways. So the next slide summarises the first of those, which is that the board has, as we've talked about, developed disclosure objectives and required companies to satisfy them. And those disclosure objectives explain investor needs in detail. Now, I'm not going to talk through each one of these, but just to highlight a key message across the feedback here was that what investors really care about is a company's exposure to uncertainty. What fair value measurements have they got and what are the associated uncertainties? And the specific disclosure objectives, which are on the topics covered in the pink and red boxes on the slides, flesh out different specific aspects of those investor needs around uncertainty. Now, as we've mentioned, underlying each objective is all of that helpful stuff to enable companies to apply judgment in meeting them. I will briefly mention two other ways that the proposals help to address the feedback we heard. The first of those two, the second of the three in total, is by requiring companies to focus on the appropriate level of detail and ensure that relevant information is not obscured by insignificant detail. Those words are right there in the proposals, and they are intended once again to reinforce those existing IAS 1 materiality requirements and give companies confidence about applying judgment, eliminating the immaterial and focusing their disclosure on fair value measurements that are material. Thirdly, the proposals avoid referring to levels of the fair value hierarchy where that is possible and helpful. I'm very happy to go into more detail on this if anyone has questions, because it is possibly the most interesting thing about the IFRS 13 proposals. But essentially, it is to remove any perception that detailed disclosures need to be provided for fair value measurements in particular levels, regardless of whether they are material or not. as we've talked about, investors really care about uncertainty here, and they've also described the levels of the hierarchy as representing a continuum of measurement uncertainty rather than 3 distinct buckets. So by way of an example, if a company has some material items in level 2 that are very close to that level 3 boundary, and without going into all the definitions in the standard, have some uncertainty associated, users are likely to care about that. So what the proposals do is put that judgment into companies' hands and say, don't just take a black and white approach, disclose loads about this and nothing about this. Give your disclosures about the fair value measurements that are relevant and important to users, and that where the information is material. So the second test case we have is IAS 19. There's a lot to IAS 19, but what I will do is focus on defined benefit plans, because a key message coming out of the board's outreach was that defined benefit plans are where the risk is, and therefore that is what users are most interested in. So what the board heard here is that the single most important information to users about defined benefit plans is their cash flow effects, but they often say they get little information on that. Another problem we heard relates to ineffective communication. So users say they receive loads of detailed disclosures, but cannot always piece together the information and understand how it relates to the financial statements. At the same time, companies say that detailed information can be onerous to prepare, and again, they therefore question the cost-benefit value. Putting all that together then, what we've heard suggests that applying the board's proposed approach here could have real benefits, this time in terms of relevant information and effective communication. It could help companies to avoid spending time preparing disclosures that aren't the most useful, and it could result in information for investors that is more relevant and more effectively communicated than they currently receive. So again, the next slide highlights, in this case, the topics of the 6 specific disclosure objectives that the board has proposed for defined benefit plans. And again, they respond directly to the feedback we heard. Now, I won't talk about all of them. You can see on there the cash flow objective that I've mentioned the importance of, the executive summary, which would explicitly be there to address that investor need about effective communication. What I will do is just pick out one example that I think nicely touches on a few of the themes that were mentioned by other speakers. And the one I'm going to pick is the objective about the nature of and risks associated with the defined benefit plans. Now, this objective, as with all of them, is followed by explanations of what users will do with any information provided and items of information to help an entity to satisfy the objective. Coming back to a point that Catherine made, this is an example of an objective where every item of information that follows is framed by the language whilst not mandatory. And that does not mean that those disclosures are voluntary and a company can disclose nothing. The minimum requirement here is to satisfy the objective about nature and risks and enabling a user to understand those, and satisfying that objective is effectively the minimum compliance requirement here. So what those items of information and the other tools do is help companies determine what is material in their case. Comparing that to the checklist approach that can be applied today, it would also help them, by virtue of the whilst not mandatory language, to eliminate any irrelevant detail that isn't helpful in satisfying the underlying user need. So narrative information about nature and risks associated with defined benefit plans is a really good example of where today some of the things that we heard in feedback information being onerous to prepare and not always focusing on what's relevant could really be benefited by this approach if, as we say, the board has given enough in the proposals to facilitate that judgment. So I will stop there, but as I say, very happy to talk in detail on any of those objectives if the audience has questions. And I will hand over to Anne for the final few slides.
Thanks, Catherine. If I may have the next slide, please. I just wanted to pitch a call for any evidence that people have or would be interested in putting together for us, because as we've explained, this is a new approach for the board, and the feedback that we're undertaking is all about gathering evidence to support a decision by the board in pursuing this new approach. So we've included 3 slides in the slide deck for today, and these 3 slides do have detailed questions that a researcher could look at. So basically, we're trying to understand better how people do respond to objectives rather than specific disclosure requirements. So with all the caveats that Paul has already mentioned about the difficulties of determining disclosure quality and all the other issues in disclosure related research, we still are interested in evidence that people can gather. So on the slides, we're giving some background to the way we as standard setters have to approach the issues and the type of evidence that we're seeking. So there's lots of details in the slides. I'm not going to read all the details, but please, if you're working in this area or you've got students who are looking for projects, there's lots in these slides where you can get evidence and it can feed into the process. So we are interested in this idea of how the disclosure objectives do work now and indeed may work in the future. So the recently issued IFRS standards, such as IFRS 7, IFRS 15, IFRS 16, have disclosure objectives in them. And so that's something that people can have a look at. I know the research has been evolving and getting more finessed in terms of trying to look at immaterial and material information, trying to look at entity-specific disclosures. They're all things that are really interesting for us. And if people can pick up on that, that would be great. Next slide, please. Of course, the overarching question is always about usefulness. Are the disclosures useful for the people that are making use of them, the people that are demanding them? So on this slide and the next one, we've just picked up some dot points in relation to IFRS 13, fair value measurements, and then also IAS 19. These are the sort of questions that we're tossing around, and these are things that we'd like answers to if we had a wish list, if we had a magic wand. This is the type of evidence that would be useful to us. So I just bring those to your attention for your consideration. Thank you very much. And I think I now am handing over to Hoseem, I think. Thank you.
Thank you very much. So in the next 2 slides or 3 slides, we are presenting a very high-level overview of the position expressed in our draft comment letter, which was issued on the 11th of May. So the draft comment letter is essentially a consultation document, which is open for comments until the 15th of October. So all the views that are expressed in this document are obviously tentative. And Catherine Schoen has mentioned the need to field test the practical application of the proposal, their auditability, enforceability. So this will also feed the final views that will be expressed in the final comment letter. So in a nutshell, on this slide, EFRAG agrees with the overall objective as spelled out in the exposure draft, which is to enable users to evaluate the entity's exposure to uncertainties associated with fair value measurement. We also support 3 of the 4 specific objectives to describe the amount, nature, or characteristics of the amount reflected in the balance sheet, to provide information about significant techniques and input used, and to explain the significant reason for changes. The one item on which we have concern is the 3rd objective, to provide information for users to understand alternative fair value measurement using input that were reasonably possible at the end of the reporting period. So the ISB is essentially suggesting to remove the current requirement to provide sensitivity analysis, and instead ask preparers to provide range of alternative fair values. And we have heard concerns by preparers on this, on the cost, on the complexity, the fact that the reasonably possible alternative output is not defined. Yesterday, we had a public event on this project, and the representative of banks, for instance, have raised concern about, especially about their level 2 assets and liability measured at fair value, like derivatives. They consider that, considering the number of lines, it could be very costly to do this exercise. There could also be some implication in terms of responsibility for management to provide information about possible upside or downside compared to the values that are in the balance sheet. So we have included a question to our constituent in our draft comment letter to seek their views on this problem and if they share the concern of EFRAG. And we are suggesting, the ISB tentatively suggesting, to keep the sensitivity analysis that is currently required. In the letter, we also make a number of suggestions for improvement. For instance, disclosure about governance around fair value measurement that is not currently addressed. Who is in charge of the valuation, who is in charge of oversight, etc. And also, we have noted that there are 3 items of information that are always mandated to meet the objective. So this does not mean that there are minimum requirements, because they are necessary but not sufficient, of course, to meet the objective. So EFRAG agrees with these 3 elements, which include, for instance, a tabular reconciliation of the opening to closing fair value for level 3 assets and liability, explanation when the portfolio exception is used, or a breakdown of the assets and liabilities measured at fair value according to the fair value hierarchy. So we think that these are 3 types of information that should be always mandated. So in the next slide, very briefly, the tentative view on IAS 19, so starting with defined benefit plans. Overall, we agree with the general objective, the overall objective, and the 6 objectives that Catherine Dunkersley has presented in her slide. Some terms we think are very broad, are not defined precisely. For instance, there is a requirement to provide information about the nature of benefit, or the nature or an extent of risk, and we are suggesting maybe to define them more narrowly to avoid boilerplate disclosures. The main concern on defined benefit plan is again related to sensitivity analysis. So here the ISB is suggesting to remove the current requirement in IAS 19 to provide sensitivity analysis for each significant actuarial assumption used. And instead, it will be replaced by an objective to provide information to enable users to understand the significant actuarial assumptions. And we believe that this will result in a loss of information. Yesterday at the public event, we also had concern from preparers telling us that sensitivity analysis were very important, especially around discount rates and the return of the investments that back the pension plan. So in the letter, we are suggesting that the ISB reconsider reintroducing the requirement to produce sensitivity analysis. On the next slide, we are addressing the other types of plan and defined contribution plans. In fact, the ISB is only proposing for defined contribution plan an overall objective, but no specific objective. And the overall objective focuses on understanding the effect on the current period statement of income and cash flow statement. What we've heard from our working groups, especially our pension panel, is that there may be more complexities even in a defined contribution plan. For instance, you may have financing features, you may have risk-sharing aspects, you may have regulatory or internal agreements that affects the future contribution that the entity will make, and therefore will have an impact on earning volatility and cash flows. So in the letter, we are suggesting that the ISB, in the context of the field test they are conducting, also look at these more complex defined contribution plans and reassess whether just providing an overall objective focusing on the statement of income and on the statement of cash flow, but not addressing the balance sheet, is sufficient. And lastly, for the other types of plan, we generally, so multi-employer plan or plan that share the risk between entities under common control or short-term plans, we generally agree with the proposals. We have made some suggestions for clarification, but basically we support the proposal. Thank you.
Thank you very much, Josine. Let's go straight to our two academic commentators. First, André, please, on IFRS 13.
Okay, so thank you, Thorsten, for the invitation to share my views on the proposed amendments to IFRS 13. I think that it's a challenge to share the views on IFRS 13 because on a proposal, because the proposal by definition is prospective, while academic research in one way, it's retrospective. So what happened up to now, and we can only speculate based on what happened up to now, what's going to happen in the future. And from this point of view, I guess our role here as academic commentators is to give the big picture and to see where does it fit and how does it fit in the existing role. And if we can go to the next slide, please. I think that my work here is very easy. And it's very easy because in the case, and I'll finish, I'll be fast and short as Thorsten, not to run over time. And why is it easy? Because in the case of IFRS 13, we had a recent post-implementation review process. And in this post-implementation review, we had a very comprehensive academic literature review. And I simply invite you, all of you, if you want to see the big picture on IFRS 13, well, just jump into that literature review and you have a very comprehensive work there with all the papers that are in the area of IFRS 13. Instead of this, I'll simply jump to the conclusions of this literature review. And the conclusion of the literature review is that basically the hierarchy of fair value, the level 1, 2, 3, is a useful information that has been disclosed to market participants. And it has been used by investors, financial analysts, and it did add a value, basically to predict the future earnings. Within this fair value hierarchy, however, it seems that there's a certain variability according to the levels, and this levels seem to vary basically based on the underlying assets, on the market conditions, and as well as on the institutional environment. And in all, as a trade-off in between, where's some gray area, it seems that this gray area in between, at the borderline in between the levels, and especially in level 3 fair value, that the management has a certain discretion, to use this, and the management can use this discretion either to increase the informativeness of financial statements or simply to deceive them to achieve certain earnings targets. So that's the basically area of gray area within this. Now that's the conclusion basically, but overall it seems it's a good disclosure, and based on the evidence provided, the ISB has concluded basically that the standard is working as intended. So if we move a little bit to the next slide, what I'm adding to this, I'm adding to some recent evidence, some papers that showed up in the last pay period. And I'm just summing up a little bit the conclusions of these papers. And it seems that this disclosure of the fair value hierarchy is more and more useful in the recent years compared to the first years. So it seems that there is a learning effect from the users as well, from the preparers. Maybe they prepare, they disclose a better information. So this relevance is increasing over time, and especially in the last years. The overall conclusion, from the recent papers is as well, that while level 1 and 2 seem to be converging, so that there's no statistically significant difference in the last years, over this level 1, 2 fair values disclosed. It seems, however, that level 3 is perceived of having less value relevance. So it's less valued by the market. So it seems that there is a gap in between level 1 and 2 and level 3. And the big question, I guess from the researcher's point of view, why is this gap? Right, because we're talking here about valuation. So why is there the gap in between level 1 and 2? Is it because of the instruments that are classified in the fair value, or is it because the market is having a certain is perceiving a certain bias in the way this fair value level 3 is actually measured. That's basically an open question, and this can be linked. I think that the project like of the ISB to focus and to show more details on uncertainties that are like linked to this type of financial instruments, that can basically help and could be like, I'm speculating here, but that could be basically like useful for the users of this type of information. And finally, a last point that it's a little bit like worrying, and it's like personally I'm questioning a lot. It seems that there's a significant gap in between like US GAAP fair values and IFRS fair values. So it seems that the value relevance is significantly lower for IFRS disclosures. And while I do agree that this part of the gap, one part can be explained simply because it's a value relevance test. So it's a joint test in between the informativeness of the numbers and market efficiency. So maybe there are definitely some differences in between market efficiency in the US and in Europe, but still the gap is significant. And this gap, it's starting to diminish over time, but it is going on for this as well. And I do question, I think that it's like, it is about uncertainty, it is about like data availability, and it is maybe something about comparability. And you mentioned the trade-off and going on to comparability and how informative this type of information is. So maybe this gap compared to US GAAP and comparing like to IFRS, my first instinct when I saw like the proposed and the challenges of the proposal was like, well, simply like to jump on the financial statements and try to look a little bit like out of it. And if you can go to the next slide, please. So I simply took my bank, and from my bank, I looked at the disclosures of what is it like fair value level 1, 2, 3, and how do this disclosure basically fit in the proposed objective and this part of uncertainty. So I took my bank, well, it's French, it's BNP. So you have like a nice way like to variation, and you have a nice, you see like they split it in between like held for trading, a profit and loss, and like everything that goes in other comprehensive income. And then they split it basically like on type of asset, like securities, long-term repurchase agreement, and you have a total of out of it. Now, roughly, if you talk about uncertainties, and if you go with what the literature is saying, I would focus on level 3, and where I would naturally like to have more information. If you see at that, probably like at that 4,564, that is a significant amount. So I do want more information. I would go and like look further in the notes, and you do have plenty of information, because if you look like this table, aggregated table, fits into like additional disclosures, and I'm just quoting like from page 71 to 80, you have plenty of additional disclosure where it does give like out of this or so. So aggregated from a researcher perspective, I would aggregate this amount. And when I was talking about before about fair value of level 1 to 3, I would simply add up like level 1 to 3. And this is what fits into the model, like from overall usefulness of this type of disclosures. Now, and I think that the trade-off is this clear? Do I have information? I think that the proposed version is going to help a little bit like about better identify the uncertainties that are linked to it, and maybe reduce, let's cross the fingers, maybe reduce the number of pages that we have here, like from 10 pages of additional information. But the trade-off for this is like, okay, how comparable it is. And comparable for it is, and maybe if we go to the next slide, please. Well, I jumped to another bank, and I just took out of, I took a UK bank, so I took Barclays. And first thing, I'm a little bit confused. I don't see, and we're talking here about aggregated information. I'm not talking about details, simply on aggregated information. I don't see exactly the same format. So I had it what they had before, split it like on one side. I have it now on the other side. Trading portfolio, financial asset at fair values through income statement. So I have to turn a little bit, like to a little bit of confusion. I don't have the exact, in this aggregated information, I don't have the exact details of what type of securities are they. Is it equity? Is it debt securities? What it is, of course. Of course, I want to go and to do it more comparable and to look like out of it. Well, I have to go into the additional disclosure. And if you look at Barclays as well, they have as well like 10, 11 pages like of additional disclosures to look more into this type of details. Now, where I'm more confused about, like from the research point of view, I want to establish the uncertainties. I look at the traditional amounts. But even if I look a little bit like one thing that and I compare what we saw just before BNP with Barclays, I see here derivative financial assets, which were not included like in the previous financial statements. They were somewhere else placed in the disclosures. I see here investment property, which again, it was like not in the other financial statements the companies are looking. So already like for me, like I find overall the overall disclosure is basically like good. It takes a lot of time to accumulate and to understand this type of disclosures. And I'm simply speaking here as a naive user, like was having like no defined professional, like simply like as a pedagogical, as an academic, when I present this to the students, we're trying to find out and to fit all this information. The comparability is important, and it's very hard, like we have to take care, like not to hamper this type of comparability out of it. But overall, again, I think that this focus like on uncertainties is a big step forward, and I speculate it's going to increase the relevance of the disclosures in the new proposals of IFRS 13. I think that I was short enough, Thorsten, so I'll go back to you.
Thank you, Andrei. So very rich observations here again, also from the perspective of researchers and their use of this information. I will now hand over to Vicky, who will have a similar set of observations for IS 19 disclosures. Thank you, Vicky.
Thank you, Thorsten. Thank you also for the opportunity to present the commentary on the pension-related disclosures. If we can move on to the next slide, please. So what I'm going to do, I'm going briefly to refer to the exposure draft, basically to link it back to what Catherine and Anne have discussed. And then I will discuss some prior literature, but I have to say that I need to be rather selective given the time constraints. And what I'm going to do, I will briefly summarize what lessons do we learn from previous studies and how do these relate to the proposals put forward in the exposure draft in relation to the pension disclosures. And finally, I will conclude and highlight a couple of issues that I think are rather relevant and important. So if we could move to the next slide, please. So basically, as discussed previously, the board proposes to replace the disclosure requirements in IAS 19 with a new set of disclosure requirements that would be based on the proposed guidance. And essentially, there will be an overall disclosure objective and some specific disclosure objectives, as well as some items that will enable entities to meet the specific disclosure objectives. If we move to the next slide, please. So the first study that I would like to discuss is a value relevant study, basically. And even though the study by Barth et al. Was carried out in a different time period and also using US data, I think it is quite relevant in the sense that the lesson we learn is that the market values alternative pension cost components and attributes different coefficients to the different components of pension expense. And basically this supports the board's proposals to actually provide disaggregated information about pension costs. So I think this is a good way forward in the context of pension disclosures. If we move on to the next slide, this is a related study that in addition to examining the value relevance of pension information, it also looked at whether analysts take pension-related information into account when providing earnings forecasts. Overall, the results of this study suggest that prices and forecasts do not fully incorporate the anticipated future earnings effects emanating from changes in pension information, even when this information is available and sophisticated users such as investors and analysts could have taken this information into account when determining the values of companies and also when providing the forecasts. So the evidence suggests that investors and analysts only gradually incorporated pension-related information into prices and forecasts. And I think the takeaway message from this study is that providing information in a clear and transparent way is rather important even for sophisticated users of pension-related information, especially because, as we know, pensions is a very complex area. Companies have to make a lot of assumptions, and I think the board's proposal to actually provide this executive summary and articulate how the pension disclosures link with items in the main body of the financial statements, I think will be helpful for sophisticated financial statement users, and of course, needless to say, for everybody else as well. If we could move on to the next slide, please. So this study by Franzoni and Marin shows that firms with severely underfunded plans are significantly overvalued, and again provide evidence that investors do not incorporate the anticipated effect of pension liabilities on future earnings and cash flows. And again, this again evidence that while pension disclosures are quite lengthy, they're also quite complex, and even sophisticated financial statement users have difficulty incorporating this information, processing and incorporating this information into prices, forecasts, etc. So again, I think the lesson from this study is that the board's kind of suggestions to allow companies to exercise judgment and also to provide information that is material and relevant in this specific situation for the specific company and for the specific pension plan is going to be quite relevant and important to various stakeholders. If we could move to the next slide, please. So there is evidence in the prior literature that hidden pension deficits of companies are quite important, and some companies, for example, in this case, French companies did not have, prior to IAS 19, they did not have to disclose information about pension deficits, and there was a lot of heterogeneity in the disclosures. And as soon as they were obliged, they were required by the accounting standard to provide this information under IAS 19, we saw that this had significant consequences for the companies in the sense that leverage was reduced and these companies incurred higher cost of debt. And overall, the evidence from this study suggests that the introduction of a more transparent regime allows the credit market to correct estimation errors and take into account the pension deficits of companies when taking decisions. So again, this study provides evidence that various market participants, including not only investors, but also creditors, use this information. So it is important to provide it in a clear and transparent way so that information about the risk involved in pension plans is clear to various market participants. And again, this is consistent with the proposals put forward by the board to be clear about the risks involved in pension plans. If we could move on to the next slide, please. So this is a study focusing on disclosures by Glaum, Keller, and Street. And basically, apart from other issues, this study examined the choice to present pension interest cost and the expected return on plan assets, or the net interest cost after 2013, in operating or financial income. So companies had the option to either present this item either in the operating or the financial section. And the findings suggest that the choice made by companies is driven by the impact on earnings before interest and tax. So this is an example of a pension item upon which companies exercise discretion when they had the opportunity to do so. So I think the takeaway lesson here is, yes, it is good to allow companies to exercise judgment and have some flexibility when deciding what is important to disclose and what isn't. However, if we would like information to be comparable, we have to take evidence from such studies into account. If we could move on to the next slide, please. It's a study that shows a positive relation between pension deficits and the cost of bank loans. And basically, this study suggests that pension deficits are an additional source of risk. And again, reiterate the proposals in the exposed draft to make information about the risk undertaken by pension plans or involved in pension plans, if you like, clear, and hence the proposals about making this information prominent and transparent are going to be helpful to market participants. And if we move to the next slide, please. Finally, there are some studies examining the real effects of pension accounting. So it is not simply that various stakeholders use pension accounting information to value companies or to take this information into account when taking other decisions, but also from the preparer's point of view, we see that pension accounting and disclosures have a real effect, as there is evidence in the prior literature that pension accounting has an impact on the pension asset allocation of pension plans and also the decision of companies about whether to close and freeze defined benefit plans or not. So if we move to the last slide, overall, I think the evidence in the prior literature suggests that providing disclosures about pension plans is very, very important, especially given that it is such a complex area with all these assumptions and other information that companies have to take into account when compiling their reports, the relevant part of their reports. I think there are two issues to consider. One is it is important to take into account the needs of various stakeholders when providing guidance to companies as to what information to disclose in relation to pensions. And secondly, it's an issue about judgment. It is good to provide flexibility and to allow companies to exercise judgment when deciding what information to present in their annual report and accounts. However, it is important to provide detailed guidance to companies about how to exercise judgment and perhaps to do some trials in order to make sure that all companies will provide the information needed. Otherwise, the risk might be that various stakeholders will not have the information they need in order to take effective decisions. Thank you.
Yes, thank you very much, Vicky. So this was a really, I think, thorough and well-balanced discussion of the proposals. There is one question in the chat that I would like to bring up because we still have a little bit of time until our window runs out. Warwick Van Zyl, would you like to ask a question, please?
Yes, thanks, Thorsten. So if I understood the exposure draft correctly, the ISB is just focusing on the disclosure requirements of these two standards. And having a look at some of the changes, it struck me that it could be difficult for preparers to apply these new rules without changes to other parts of the standard or other standards. So the example I thought of is the IFRS 13 requirements rely heavily on the fair value hierarchy, but the fair value hierarchy is very rules based, sort of very rigid rules that you apply to determine which level those instruments fit into. So it could be difficult for somebody to apply judgment, for example, when they sort of restricted to the, very sort of rules-based hierarchy on the one hand. And then the other thing that I thought about is that IFRS 13, of course, quite closely related to IFRS 7, and again, might be difficult to apply judgment in the context of IFRS 13, whilst having, I think, a very different approach in IFRS 7. I mean, I would describe IFRS 7 as a sort of collage of different disclosures which is, I think, difficult for many companies to give, and in general you just get very boilerplate type disclosures for IFRS 7. So I guess my question is, is that the intention, is to just look at the disclosure requirements, and what about some of the interrelationships with the other parts of the standard and other standards?
And you and Warwick are colleagues. Would you like to take this, or would like to respond?
I am happy to comment. I don't know if Catherine wants to go first. Catherine, are you there?
I will comment if that's okay. I'll respond in two different ways. The first is to say that almost the direction of this project was it started as a response to the disclosure problem, and both standards, including IFRS 13, are being used as test cases. And one thing that the board is always conscious of is what we call scope creep. So all of our projects exist because stakeholders have told us about a problem that needs to be solved, and there's always and as you rightly mentioned in this case, ways in which it would be great to catch everything that is relevant to the topic and deal with it all together. But the problem with that is we would never deal with the most important problems that our sort of agenda consultation and such has identified that the board needs to focus on. So there's a bit of a general point there, and the short answer is that yes, this is just about disclosure, and anything else is not within scope. The other thing I've mentioned on your IFRS 13 example specifically, I think one of your examples was about the hierarchy being quite rules-based, and I think that is fair, but personally I don't see that as being like a problem between what we're doing on disclosures and what is there in terms of recognition and measurement. So to stick with that example I talked about earlier about level 2 stuff that is close to the level 3 end of the spectrum, that rules-based sort of hierarchy is focused on, when you think about the 2-3 distinction, whether there is any level 3 inputs that have a significant effect on overall measurement. And actually that determination at the 2-3 border, it does involve a degree of judgment, as with everything in IFRS standards, and therefore there is a genuine user need that exists. And I will say that our outreach did include talking to banks and such who acknowledge the same. There is a genuine user need that is reflective of existing recognition and measurement requirements, and it is about what is disclosing what is being done today as effectively as possible. But just to say, we absolutely have thought about those issues. I'll stop there, and I don't know if you have anything to add.
Thanks, Catherine. Warwick, thanks for the question. I think it's a really, really good question. It's very thoughtful. Thinking about IFRS 13, because it doesn't tell you when you will measure, it tells you how to go about your fair value measures. So I think about IFRS 13 as being a subset. So when we think about IFRS 7 with its great range of disclosure requirements, so within there, if fair value is required, then I cross-reference then to IFRS 13, and that becomes the point. So I suppose that's how I've been thinking about it. So that's how I think you can change 13 without changing 7. But I think it's great you've raised the point, and Catherine will take that away, as will I. We will take that away. It makes me think about, Catherine's mentioned banks, and you're mentioning IFRS 7, but what about fair value in other standards? What about if you're the Australian public sector, where they've got all the assets on fair value? I mean, they do replacement costs, they're doing fair value. I'm really looking forward to their feedback. I hope that they are across this ED, and I'm really looking forward, because it's a very unique setting in the public sector where there's this great use of fair value measurement on a whole range of assets. When I was on the AASB, I did hear concerns from some people in that sector about the IFRS 13 requirements. And so we didn't substantially change them through the post-implementation review. So that is a sector that really could give us some interesting feedback on how IFRS 13, how a new approach, how they would deal with a new approach with a standard that isn't financial instruments and isn't financial institutions. So thanks. Thanks, Thorsten.
Thank you.
Thank you very much. There currently is no more question in the chat, but I, having the privilege of being the moderator, I would like to actually ask or raise a point that kind of has pervaded much of the discussion and many of the comments that we've heard today. And it's really something that interests me, not only in this context, but also in the context of other standards. And that is really, how much weight do you or should we put on preparers' views? What are valid arguments when really the conceptual framework talks about decision usefulness to users mostly? And let me make 3 specific arguments that I think you hear a lot and that I also hear when I talk to preparers. So this notion of some disclosures are onerous to prepare, something that Catherine has mentioned a couple of times. That is probably true for financial statements per se. So to what extent is that a valid argument? Secondly, this notion of too much information. This is something I can't really remember hearing a lot from investors, from users, and it's also unlikely that in efficient markets, when users are sophisticated, or at least some users are sophisticated, when they use data analytics, when they're professional information intermediaries, that this is going to be a problem, because it seems like investors, they know how to pick information they need, as long as there is something to pick from. That's also something that Paul mentioned in different words. And finally, then, I often hear from practitioners, from preparers, nobody ever reads this, or we don't ever get questions about this disclosure. And what kind of conclusion do we draw from these kinds of statements? We can't forget the confirmatory role of accounting, right? So in a classroom setting, when I tell students something and they don't ever ask me about it, does that mean that they didn't get it, or that it's not relevant for them? Or did that just mean that I did a good job explaining and there's no questions left? So maybe a couple of thoughts, if I may ask you, would be interesting. Thank you.
Catherine, do you want to go first?
Yes, I'm happy to jump in again. What I might do is take 1 and 3 together there. So 1 was about companies having to do something is by definition onerous, and how much of a problem is that, and 3 was about information not being read. I would say that the board thinks about costs or onerousness for preparers and usefulness together. So the combination of companies saying something is onerous and evidence that it is not useful to investors is something of a killer combination, and that's when those things become important. Your point on things not being read, and it could have just been brilliant information in the first place, is a fantastic point, and you phrased it so well. I might have to borrow that in future. I would say that one thing we do is make sure we've talked to every stakeholder type. So if a company says to us, investors don't ask us questions about this, that wouldn't in itself be enough for us as staff to say to the board, okay, this disclosure isn't useful, or for the board to conclude that. We would also need to hear from investors directly. So it is possible that things aren't read, but they're still useful. I think that is really, really valid feedback.
Catherine, just one more sentence. Something else you may want to borrow. I borrowed it from somebody else. You only miss it when it's gone, right? It goes for disclosures too, I guess.
Very, very true indeed. The other question you asked was about the concept of too much information and investors never really having that problem. All I can share there is a bit of personal experience based on having led this project for 4 years and spent those 4 years talking to everyone in the world, especially investors. And it is my view, based on all of that, that is a bit of a simplification of their position, because some investors have consistently told us that when they get loads of stuff that isn't useful, that prevents them from getting to what they need. And if, for example, you look at the buy side, they are not spending hours and hours and hours working through 200-page set of financial statements. So the best example in our test standards of that is so many investors have said to us, okay, all I want to know is how big is the defined benefit obligation. And when I know that, sometimes I don't care about anything else. And they have told us there's times when they go to the IAS 19 note and coming to that point about effective communication, they can't quickly see what's the obligation. Sometimes they say it's not clearly there at all, no matter how much time they spend on it. And therefore there are cases where they would like way less and an absolutely explicit clear statement at the top of the note, you know, obligation X, income statement X, cash flow effects X, and then they may want to move on. So that's just one example, but I think fully acknowledging that some investors, for example, those that consume information electronically, would want everything under the sun and pull what they need from it. I don't think that's true across the board, and investors do really want that strong communication and conciseness sometimes. Anne, would you add anything there?
Yeah, a couple of comments. I did want to talk to number 2. You went 1 and 3, so I'll grab 2, which was about, you know, preparers saying that they're required to give too much information. And Catherine touched on costs and benefits, and that does really influence the decision-making process. So the more we know about costs and people are quick to tell us about them, that's fine. But then we work very hard to get the information about the benefits. But I did think digital, and Catherine did just mention digital, the landscape has changed so much. You think about how it was when we did the Principles of Disclosure discussion paper several years ago now, and there's many people on this call are familiar with that. And there were things in there that we don't even talk about now. There were things about, you know, where you position things and where they appear in the financial statements. We don't talk about it anymore because we know there's so much more consumption electronically. And as we go forward, there's going to be so much more consumption electronically and more tools to analyze those note disclosures, which will be useful for investors, but equally useful for researchers. And the irrelevant information is just going to fall out. So, you know, where's the benefit for the companies just providing this stuff that's going to fall out of the analysis as the tools get the relevant information? And then finally, I'll make this my final comment. Thorsten's overarching or introductory question was, you know, something about the influence of preparers, how influential preparers are in the standard setting process. And it is true, they are very influential and they are listened to, and they're quite vocal as well about their position. However, you just look at the track record of the IASB. The IASB does not always do what the preparers ask for. They don't. The board doesn't, and that's the fact, and that just reflects the process where it is cost benefit driven, and we are looking for what the problem is we're trying to solve, and therefore we're looking for the users, what they tell us they need. So I'll stop there. Thank you, Thorsten.
Thank you very much. A pleasure as always. There's another remark in the chat by Ann that I'll not read out. For you to consider. We will again save the chat and send it to you for later consideration and summary. All of you, again, the active participants from the ISB, from EFRAG, from the academic side, thank you very much for being a part of this again today. Thanks also to those who have attended and also to some extent actively participated. We will, by the way, be doing an evaluation of this format next week with the ISB, and then also hopefully collecting some feedback from you, the participants, over the summer. Feel free to send me an email if you would like to let me know your points of criticism or your suggestions for improvement about this format, and I'd be happy to consider it. We'd be happy to consider it for our next set of events starting after the summer. I should also mention something that Pauline was so good to bring up, which is a call for papers that that really fits very well to today's discussion. That's the one on corporate disclosures, launched jointly by Accounting in Europe. The British Accounting Review is also supported by the ISB. So that's something you may want to work on over the summer, you know, putting together a paper that speaks to these issues. So having said that, everybody have a good summer and hope to see you again soon. And as I keep saying, of course, not always with a screen between us, but hopefully at some point also in person. Thanks a lot.
Thank you.
Thank you, Thorsten.
Thank you.
Thanks, everybody.
Bye.
Bye.
Thank
Bye.
you.
Thank you. Cheers.
Thank you.
Bye.
Bye-bye.
Bye.